In this video, we're going to explain the basics of the net wealth finance strategy. We'll walk through how you can use whole life or index universal life to build wealth, lock in compound interest gains, never lose access to liquidity, capitalize on cash flowing assets, and take advantage of arbitrage opportunities. Let's get into it. Net wealth finance is a term that I created because I believe it best describes the strategy of using high cash value life insurance as a tool for wealth building. Many people call this the infinite banking concept, bank on yourself, be your own bank, cash flow banking, and various other names. Net wealth finance is a good name because we're using our net wealth, also known as a death benefit, to create a line of credit to replace aspects of traditional financing. This does not actually replace the need for banks, as we'll still use them to access the funds from our line of credit. High cash value life insurance has some distinct advantages over many other financial instruments. The gains within a life insurance policy are tax deferred, but we can access them without taxes through policy loans. Additionally, the death benefit passes income tax free. So if done right, you may never have to pay taxes on the gains from life insurance. Whole life insurance always has some guaranteed growth. Currently, this is required to be between 2 and 3.75%. It depends on the carrier and product what the guaranteed rate is. Index universal life, IUL for short, will have downside protection and can sometimes have a small guaranteed return as well. I personally have both a whole life policy and an IUL. Which is better really depends on a person's situation. If you don't want to have any more of your funds correlated with markets and you want to have the best savings instrument, then whole life is a great option. If you're young and healthy and have a lot of time for compounding, then IUL could be really good due to the lower costs earlier on. Those are some of the basic principles, but we would surely want to know and understand your overall financial picture to recommend a specific one for your situation. When properly designed and funded, a whole life insurance policy should be able to have an annualized internal rate of return between 4 and 6% over the entire life of the policy. That kind of return only happens with a few mutual companies. All carriers are not equal. When you're a policyholder with a mutual company, you're basically a partial owner in that company. The returns you get on your policy are called a dividend. An IUL works a bit different. They use your funds to invest in assets that pay a small yield, very similar to what whole life does as well. But then they use that yield to buy call options on an index. That's how they provide downside protection, but this is also how they can provide larger gains. When properly designed and funded, we should be able to see an internal rate of return between 6 and 8% over the life of the policy. Some years could be significantly higher. At the time that I'm recording this, I could actually lock in 14% for one of my indexing strategies in my IUL. Liquidity is one of the biggest advantages of cash value life insurance. We have a contractually defined ability to borrow against our policies. You also have the ability to surrender or partially surrender your policy. This basically means you can cash out some or all of your policy. There could be tax implications for the gains if you do this. Policy loans are really the best way to access our cash value during our lifetime, since there's no tax implications. We can use our policies like a line of credit. There are different loan structures depending on the product. Whole life carriers and products have the concept of direct recognition and non-direct recognition. Direct recognition means that the carrier will adjust the dividend for funds that have a loan against them. This does not always mean that they will lower the dividend. There have been circumstances where the dividend has been higher on borrowed funds. Non-direct recognition means that taking loans against your policy does not impact the dividend crediting. IULs can have two main categories of loans. An index loan is where they set an interest rate for you to borrow, but the funds continue to earn based on the indexing strategy your funds are in. This is generally the preferred way to borrow against an IUL. The non-index loan means that they allocate the funds to an account that earns a rate they set rather than based on an indexing strategy. This is sometimes called a fixed account. Each year, the carrier will set what rate they will pay in the fixed account. Generally, the interest does not compound until the policy anniversary, so it's simple interest until then. If it hasn't been paid, then it will be added to the loan balance. Some carriers have fixed rates and some have variable rates. It may even vary by product for a given carrier. A wash loan is where the carrier will credit your policy for the same amount they are charging you in interest. Many carriers offer this. You are never actually required to pay off the loans. If there's a loan balance when you pass away, it's just deducted from the death benefit. Since life insurance is one of the most secure assets in existence, many financial institutions feel confident in using it as collateral for a loan or a line of credit. This is commonly done with whole life insurance. We can create interest rate arbitrage through life insurance. Arbitrage is the difference between the rate we are paying on a loan and the amount those same funds are earning. For example, in my IUL, I can borrow at a 5% fixed interest rate. Earlier, I mentioned I could potentially lock in a 14% return on part of my policy. If I were to lock in that return, then I would basically have a negative net cost to borrow of 9%. I will have earned 9% in addition to however I use those funds to grow wealth elsewhere. Arbitrage is much more commonly possible with IUL, but it can be possible sometimes with whole life or by using an IBLOC or an insurance-backed line of credit. The net wealth finance strategy allows you to capitalize on cash flowing assets by using the cash value of your life insurance policies to invest in assets that generate cash flow, such as real estate or businesses. We have various video examples where we walk through doing exactly this with the BRRRR strategy of real estate investment. Check some of those out. If you have a regular brokerage account, you could use a securities-based line of credit or SBLOC to do something similar to the net wealth finance strategy. There are some big disadvantages to this though. You do not have tax advantages in a regular brokerage account, and you'll only be able to borrow a much smaller percentage of your portfolio since it's possible for asset values to go down. You also run the risk of a maintenance or margin call. That means that if the values go down, you may need to fork out cash or be forced to sell assets to cover the margin. One thing that should be considered with high cash value life insurance is that it does take a few years to break even with the money that has been put into the policy and the accessible cash value. With a young and healthy person, this could be as little as 3 years in an IUL. Generally, we like to see somewhere between 4 and 7 years to break even with an optimally designed and funded life insurance policy. Some people in this business say that it's best to abandon traditional retirement accounts or investments and just use life insurance. We do not agree with that. We believe that life insurance can be a solid asset to add to most people's portfolios, but in most cases, it's just one piece of the puzzle. One example of another piece is the traditional 401k or IRA. If you have a desire to lower your current taxes, then being able to deduct the contributions can be a really easy way to do that. Since we generally put post-tax dollars into life insurance, we are not getting a tax deduction in the short term when we start funding a net wealth finance policy. Another useful tool that can be in a normal brokerage account is tax-efficient dividends. We're not going to talk about that in depth, but qualified dividends can be tax-free or limited taxes if you're able to minimize your taxable income. This can work really well in conjunction with net wealth finance in retirement. If you're interested in getting started with this strategy, or even if you just want to chat with me about other topics, book a meeting with me. I'm a U.S. Army infantry veteran that pivoted to working in technology, and I've been passionate about finance my entire adult life. Our goal is to get people on a path to financial independence, so sometimes that means we do business together. But I'm also happy to provide coaching for other aspects of life to people that need it. You can also feel free to drop questions in the comments below, and I'll follow up with you. I hope this video was helpful. If it was, hit that like button. If it wasn't, hit that dislike button. You do you. Thanks for watching.